Hey everybody, it's Matt. It is Friday, December 23rd, about to be 11 a.m. in Houston on a very cold day, and I think it's probably freezing cold for everybody watching this. So stay warm and stay safe. Uh, Merry Christmas, Happy New Year, Happy Holidays, Happy Hanukkah. I think it's the fifth day of Hanukkah today. Whatever you celebrate, or if you celebrate nothing, I just hope you're having a good end of the year with family and friends. Um, I am getting inundated myself with end of the year emails. So if a 2022 review and 2023 outlook are not of interest to you, you can just stop the video and turn it off now. Uh, but I do feel like I at least want to cover kind of my sense of what happened in 2022 and I guess talk to you about what the smart people are saying about 2023. Um, you will come to see that I think it is all pointless and a waste of time to focus on it and worry about it. But nonetheless, let's just hop into it. At least if you spend time with family and friends over the holidays and there is a know it all telling you that they know what's going to happen with the market, I can arm you with some pretty good information to have a discussion around it. So, I want to focus on the 2022 review, the 2023 outlook in quotes, and then what am I doing for people whose money I manage. So, all right, the 2022 review. The story is not stocks. Bonds are the story of 2022. The reason I say that is we can pull up and we can look. I'm using the S&P 500 stock index, U.S. large and some mid-sized company stocks as a proxy for the market. I say this every time. It's not the market, but that's what everybody uses as the proxy for the market. So just to stay stay on the same page as everybody else, I'm going to use it as a proxy. Through yesterday, it's down 18.5%. That is a bummer. I'm sorry about that. I wish that was not the case. It's been down as far as 25% almost. So it's a bear market. It's so far kind of a run-of-the-mill bear market. Peak to trough in 2008, we were down over 50%. The tech crash in 2001 was pretty bad. 2018, most people don't remember this, but in 2018, in the fourth quarter, we had about a 20% drop. So I guess what I'm trying to say is for stocks, this is the price of admission. These kind of things happen from time to time. They're no fun to go through. You don't want to be in a position where you're forced to sell stocks when they're down 20% from their all-time high. But that's the whole point of working with me or somebody like me, to get your allocation right so you don't have to sell these stocks. But this is run of the mill. This is what happens. It's price of admission. We just have to suffer through it until things recover. And I wouldn't be in this business if I didn't think that they were going to recover. So the story is bonds. I'm going to show you a few things. BND is the Vanguard Total Bond Market ETF. So that's the U.S. investment grade bond market. And bonds, you learn in school, academic wise, are supposed to go up when stocks go down. They're supposed to be a diversification tool. Bonds are having their worst year in aggregate as a whole, as a group, in 250 years or something insane like that. In all of modern history, this is the worst year for bonds. I will show you why in a little bit, but just trust me that this is the story. They're not down as much as stocks as a whole. They're not down as much as stocks. But what we would have expected is that they should be up when stocks are down, or a simple way to think about it is that bonds go up when stocks go down. They don't. And actually, I'm going to move my little head over here just so I can show you. I'm not going to go through all the math, but I'm just going to say that as a whole, bonds stand to lose about 6.5% in value for every 1% increase in interest rates. And for a long time, that hasn't been a worry. Let me just show you. So here are This is a chart of the federal funds effective rate of you may have been hearing about this all year. Is the Fed going to raise interest rates? This is what they're talking about. And we see that recently, at the end of this chart, rates have gone up. Now we look at this and we say, okay, well they're about here. They're actually higher than that 3.78. I'm not sure why they're in the 4% range. But anyway, this will catch up with it. But the point of this chart is like, yes, they have risen, but relative to history, they're kind of around maybe what a long-term average is. But for a lot of people's lifetimes, I was born in 81. Rates have only overall come down. They've gone down in general with some spikes up along the way. But for a lot of people's lifetimes and investment histories, interest rates have largely come down over time. And when interest rates go down, bonds stand to gain 6.5%. If we use this current metric, for every 1% that interest rates go down, bonds stand to gain 6.5%. So you could say, well, okay, interest rates were at 15 in April of 81 and got up to 19 in June of 81. And then they subsequently went all the way to zero. So rates going down pushes the prices of bonds up. And that's where we've seen a lot of the offsetting stock and bond stuff where they serve as diversification tools for each other. So it's been shocking for a lot of people to experience, oh, well, now interest rates have gone up. My stocks are going down because of that. And my bonds are going down. Interest rates have gone from 0 to, call it like 4.5. So they've, like, remember, for every 1% increase in rates, the bond market as a whole should lose around 6.5%. So you do get yield, like you do get coupon and interest payments, and so this is a combined price return, but also reinvesting the proceeds of income you get. So anyway, this is the story. And I'm going to show you a subset of the bond market that I think, I'm going to show you a couple of subsets of the bond market that I think are like, this is just super fascinating from my perspective and way more interesting and important than, the stock market being down. Okay, I'm just going to call this the total U.S. bond market. It's not everything, but it's close enough for argument's sake. I'm going to show you a subset of it, which is long-term government bonds. So these are 20-year plus treasury bonds. The U.S. government issues like up to 30-year bonds. If you owned long-term government bonds as a diversification tool, as a hedge, I mean, this is just absolutely catastrophic. They're down 28%. They're down 10% more than stocks are. At their worst, they were down over 35%. That is unbelievable. I think and hope that I never see that again in my lifetime. That is terrible. And why is that? Well, long bonds, they are expected to move up or down 17.5% for every 1% increase in interest rates. That's a lot of movement. And when interest rates go against you, that's a lot of loss. So this is just mind-blowing. And, if you're around people and they're focused on stock market and what's going to happen, yada, 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 this is the story, our bonds. There are other segments of the bond market, short-term bonds. Short-term bonds are not down nearly as much because they move far less based on interest rates. And there are some bonds that are actually up. These move extremely little with interest rates. But of course, with all these, you get a correspondingly lower yield as your risk comes down. So what was going on for years and years and years is that people were saying, well, the highest yield I can get is with these. So I'm going to go for that because I need the income. And this is basically paying nothing. So why would I ever own that? It doesn't pay me anything. Well, the answer is if interest rates go up, you get blown up right here and you don't get blown up right here. And my philosophy on your bonds is that I'm not looking for capital gains in your bond portfolio. I'm looking at it as a source of dampening volatility and generating some income. So this is the story of 2022 from my perspective. So then we get to, all right, well, why? Like, why did this stuff happen? And this also, I guess a lot of this is fascinating to me. So I've talked about this, the increase in the short-term interest rates that are set by the U.S. Federal Reserve. That has been the cause. And we look at this chart and you're like, I don't know, that just doesn't seem that big of a deal. I mean, we had like a pretty dramatic rise between 2004 and 2006, and markets like took off during that time. But the reason it matters is because when we shorten it down to just look at it over the last year, the rate of increase is dramatic. This happened fast, and significant, like, total rate of increase. And the markets had done really well for like 10 or 11 years, and you started seeing bubbles like everywhere. Bonds, as I just talked about, were richly priced. You see unprofitable companies being, valued at billions and billions of dollars with like no business to even show for it. I mean, you can think about like WeWork, or a lot of the fraud companies, or crypto tokens that are completely useless and worthless. There's just a lot of room for the markets to fall, and when interest rates start rising like this, rising interest rates are, all else being equal, they're bad for stocks. So that's why it happened. But what's interesting is to go back and look. So the Fed funds rate is set by the U.S. Federal Reserve, and they tell us where they think this is going. Like, they try to give projections about what they believe that they are going to do. Not like what is the market going to do, but what are we going to do? They try to give you a heads up, try to give us a heads up. So I think this is really interesting. I pulled up the summary of economic projections from the Fed. This was released September of 21, so going into the end of last year. And it's really interesting to look at this. There's a lot of stuff. I'm going to try and get to the point. This is, if you ever hear in the news, they talk about the dot plot that comes from the Federal Reserve. This is the dot plot. And what the dot plot is there's a board of governors, like these human beings that sit on the board of the U.S. Federal Reserve. And they are the ones that get together and set what the interest rate is going to be. And that board cycles, and there's, the members change over time. And so there are a number of members. Every dot here represents one member. So they don't tell you who is which dot. They just say, like, here are the anonymous members of the board. The members of the board are not anonymous, but on this sheet they're anonymous. You don't know who's saying what. And they're saying what should the federal funds target rate be. So for calendar year 2021, remember this is September of 21. For calendar year 21, they all agreed it was between 0 and 0.25. So here we're at the end of September, and now we're going into 22. And what is the Federal Reserve telling us that they believe they will do in 2022? At the time, a lot of the members thought that interest rates would not go up. They would remain between 0 and 0.25. Some members thought that the interest rates would go between 0.25 and 1/2. And then what might be considered the hawkish people that thought rates should be higher than they were, those people thought that rates might go between 1/2 and 0.75. So all the members believed we'd be at 0.75 or below. And a lot of them thought 0.5 or below. So that was leading into 2022. That was what the people that make the rules expected the rules to be in 2022. So what happened? The green line is they're setting new interest rates every time they got together. The green line is them increasing rates, and right now they are targeting between 4.25% and 4.5%. So this green line is the upper bound of the range that they're targeting. So September of last year, the most hawkish people thought they could get up to a max of 0.75. They are at 4.5 right now. And these are the people that make the rules, telling you what they believe they will do. Like, what are the rules going to be that we get to set? So, this took a lot of people by surprise. It took the market by surprise. And I don't know if it's in an email or a video that I sent anywhere, but I would have been one of the people telling you at September of 21, I would have been one of the people saying that I think inflation is transitory. I think it's caused by supply issues as a result of COVID. And I would have been totally wrong. We would have gotten fried had we made decisions based on that. The good news is I don't think myself or any other people can really predict this stuff, because even the rule makers can't predict this stuff. So we don't make investment decisions around like what my hunch is. We have a much more stringent process to do things, and I'll show you that later and get into it. But I just think it's so amazing that the people that make the rules guessed up to 0.75 in the most extreme cases. They have gotten to 4.5, which is crazy. And now, when we look at the most recent release, this one is from December 14th of 2022, the Summary of Economic Projections. Let's scroll down to the dot plot. Okay, what is the Fed telling us? Well, they're all in agreement. We should be between 4.25 and 4.5, which is where we are right now. There's no more rate increases for the year. Okay, what are they telling us? Well, now for 2023, they are saying between 5.75, the two most hawkish people think 5.75 is the upper bound. The lower bound, the most ease, the most dovish, the most chill members of the board, they think the max will be 5%. So between 4.75 and 5. So the center of gravity is here. It's between 5 and 5.5%. And remember, we're not there yet. So the Federal Reserve is telling us we're going to raise rates another 0.5 to 1%. We're going to cross 5%, which is a big deal. So why do I have this blue line here? Well, the blue line is 2-year Treasury bonds. What are those yields? And a lot of people use these as a proxy for what is the market saying that this interest rate should be, or what is the market pricing in for this interest rate. And so we go back to 2021. Fed funds is basically at 0. It's between 0 and 0.25. And the 2-year bond yield is like right on top of it. They're like, the market's like, yeah, this is the appropriate yield. Well, get to October of last year, inflation becomes more of a concern. The market starts saying, hey, we think the Federal Reserve is going to have to raise rates. And so you see the blue line focused on that. And the blue line starts moving up. And the way you can interpret this is, at this stage in March, the market has given the Federal Reserve room to raise interest rates. They're saying, hey, yeah, we think interest rates should be at like 2%. And so the Fed was like, okay, you're giving us the room to do this. We're going to raise rates. Now, they only raised 1/4 point, but whatever. So the market, the story I'm trying to tell you is that the market, bond market, has been kind of a leading, giving room for the Federal Reserve to raise rates. I don't know if I'm going to say this later, so I'll just say the stock market is considered to be, participants in the stock market are like considered to be kind of like dumb cavemen, very basic intelligence. The bond market is considered to be the rocket scientists, smart people. So the bond market, if the two markets are saying different things, generally you kind of want to go in the bond market. So the bond market is saying, hey, like over time, we're giving you room. We understand rates have to go up. We think rates are going to go up. And this just means that it's priced in. It doesn't mean that like bonds and stocks don't go down in price, but it's more of like the expected is going to happen. Even if it's negative, we expect it. And so that's okay. What's happening now is the bond market peaked in like November. I can't stand the way this cursor's working, but look at the blue line. It peaks in November and then it starts coming down. The bond market is now telling us we don't believe the Federal Reserve can keep raising interest rates. We don't think that that is where this is headed. The Federal Reserve underestimated where rates were going to be going into 2022. And look at that. I mean, even in 2023, like the consensus was somewhere between, I don't know, 1.5% and 0. So we think, anyway, I shouldn't have even bothered to say that. Going into 2022, they underestimated where interest rates were going to go. In 2023, what the bond market is saying, the Federal Reserve is now overestimating. We don't think the Federal Reserve is going to take interest rates above 5%. And we are showing that by pricing 2-year bonds in the 4% range. So the bond market is essentially saying we think the Fed is done raising rates. And the Fed, every time they get on TV, they're like, we're not done. Like, don't fight us. Do not fight the Fed. Take our word for it. We are not finished. But the bond market looks and they say, well, you guys are clearly causing a recession. Like, we can see a recession coming. The economy can't handle it. We can't afford to pay these high interest rates on our national debt because we don't have enough money. So you can't keep interest rates this high for that long and have them go much higher. Your hands are tied. A recession is going to force you to reduce rates, which when we look back in time, that's what happens. These gray vertical bars are recessions, and you'll see that interest rates are forced down to ease monetary policy to make the economy pick back up. So the bond market's saying, hey, you're forcing us into a recession, and that recession is going to force you to reduce interest rates. So this is really, really interesting to watch and pay attention to and be aware of. I think that is all I had on the why. Basically, it's interest rates and inflation, and the market can price in the expectations of what's going to happen, and that's led us to be down. But then the market is also a leading indicator, so if it believes things are going to improve, we'll start to see things improve before even rates come down. They don't have to come down for the market to start improving. Okay, so that's why. Inflation, interest rate, slowing growth fears. I'll get into that in a little bit. All right, so then the next thing is, I think we're done with a review. Yeah, all right, market outlook. So I get pretty salty about this, so I hope my attitude doesn't come across as super arrogant, but put outlook in quotes because it's just sales. It's just people marketing to you and to me and to everybody else. I know that because I worked for these companies for 14 years, and it was my job to market using this stuff. The goal is to make you think we're super smart so that you invest your money with us, and then we charge fees on that. And that is like the game plan for these fund companies and money managers, that's their value proposition, that we have this outlook. We are super smart, and put your money with us and we'll make you rich. All right, so the first thing is, I say this all the time, somebody asks you, like, what does your advisor think about this, or what do you think about the market? My answer, my favorite thing is, I don't know and I don't care. Comes from a book that I really enjoy by Benjamin Graham, and that's the reality. I don't know. Nobody knows. Doesn't matter. That's not what we're focused on. But anyway, you've heard it from me a million times, so I put this big but in red. I will actually give you some answers here. Here is what the experts are selling. This is not what they're telling you. This is not where they're putting their own money. It's just what they're selling. So let me see here. Okay, so this is where I pulled up kind of a fun thing to look at. So this is Wisdom Tree. This is where I worked for the last 8 years prior to opening this firm for from like 2011 to 2019, they manage about $65 billion in money globally across 100 some odd different funds with all different investment objectives. So all types of stocks, all types of bonds, a bunch of cool like alternatives and derivatives and things like that, foreign fixed income, like lots of cool stuff. I personally know and worked with, and spend a lot of time with 4 of the 5 authors of this. They are unbelievably smart, far smarter than me. Brilliant people that know what they're talking about, know what they're doing. The only one I don't know personally is Scott, but everybody else I know well, and can like text them personally and chat with them. These are very smart people. I'm not denigrating them. But what I'm going to illustrate here is I used to go give this presentation to financial advisors all the time. And the goal is to tell them what we think is going to happen and then offer solutions to address what we think is going to happen. And we might be right, like 1 out of 5 times, and that makes us look good. But we're not right 100% of the time, or probably even more than 50% of the time. Everybody wants you to have an opinion, and particularly the advisors who their entire value proposition to clients is that they're going to predict this stuff and put you in the right funds. That like they need it. They need somebody to come to them with an opinion, and here's the opinion. Here's how you justify it. Here's all the big words you use and the fancy things you say to justify it. Here's the charts that look all important. And then here are the funds to go tell them you've got the solution for them. So I'm not going to go through the presentation. I'm telling you, if I wanted to, I could sound absolutely brilliant going through this and make a beautiful case for everything they're saying. It used to be my job. That's Wisdom Trees. Here is Fidelity's. They need to, they're going to have some important charts, some really cool looking things. They're going to look real smart. Here is BlackRock's, I think. No, Spiders. This is State Street Spiders. These people, certainly, I'm sure they're all brilliant. They've got, it's funny that these things wind up sounding like poetry, between hope and fear. You got to hedge your bets, right? They're going to make a call saying, we think this is going to happen, but they certainly need to write in, well, but here's where it could go the other way. So that in a year from now, if somebody calls them out and they're like, hey, you're wrong. They're like, well, no, we pointed out it could have gone the other way. So hope for a soft landing. Hope is always a wonderful investment strategy. Fear of the Fed, mind the gap between the economy and the market, whatever. So what do you do about it? Well, you play offense and defense with dividend pairs. Have your cake and eat it too. Anyway, Vanguard. 4 key topics from our 2023 economic and market outlook. Central banks are going to maintain vigilance, so on and so forth. Here's BlackRock's 16-page new investment playbook. Can't stick with the old stuff. Can't stick with the tried and true. You got to definitely make changes in your portfolio. PIMCO for bonds. Risk off, yield on. Whatever. I pulled this one up. So I actually Googled, I was Googling all these just to pull them all up for you. And what I think is really funny is Vanguard market outlook for 2023. State Street Spiders, which we already looked at theirs, they don't even hide it. They've got a sponsored ad on Google. You type in Vanguard, you get State Street, and then they don't even hide it. They're like, here's our market outlook, but if you don't even want to click on that, you can just buy our small cap fund. You can buy short-term corporate bonds with this ticker symbol. Play offense and defense with dividend players, which we just mentioned. And also add dividend pairs using SDY. Like they're like, look, we don't even care if you open our research. Here are the ticker symbols to go buy and invest. So it's like I'm pretty salty about it because it drives me nuts that there are people that spend unbelievable amount of time and energy and effort reading these things and trying to decide who's the smartest and who's the rightest and which way they're going to invest and go. And it's just a total gamble. And even if you get it right, even if they're like, yeah, small caps are going to do well next year, or everything we say that's going to make small caps do well, everything comes to fruition, they still may not behave the way you think they're going to behave. So it's just kind of like pointless. So here's what they're saying. The Fed is either going to raise rates above expectations, which goes back to this chart here. The Fed is going to continue to raise interest rates higher than what the market is pricing in. Bad. Or they pivot and they reduce rates. So the market believes they're going to pivot. The market thinks the Fed is going to have to reduce rates and come back down below. So that's what the market's pricing in. So depending on who you read, they'll have different opinions on this, and they'll hedge. They'll say it both ways. A recession may or may not happen, which is super informative. I can tell you, I think a recession is being priced in right now. I think the market tends to believe that interest rate hikes are either over or almost at the very end, and inflation's on its way down. That's going to be 2022's story. That's what the market believes right now. And so the reason that you're seeing negatives in stock prices lately is more based on pending recession in 2023. And then everyone has to throw in like what is the non-stock related stuff like China, Ukraine, Russia. Those might get better, they might get worse. China might reopen after having their like zero COVID policy that crushed global growth and supply and all that stuff. They may reopen. It looks like they're starting to loosen up right now. It also looks like they're having an unbelievable amount of new COVID cases. So maybe they'll tighten. We don't know. Who knows? Ukraine and Russia. I don't know. I don't know what's going to happen with that. And neither do they. So, but those are the things that they're talking about. They're going to drive markets next year. I don't know. I don't care. The key takeaways from this are nobody knows. They don't invest in the funds that they tell you to go buy. So like when State Street, and we own State Street funds. I'm not saying they're bad, but just they are a marketing organization. It's what they do. When they tell you that you should buy this ticker for small caps and you should buy this one for corporate bonds and this one for dividend payers, State Street is not taking their corporate money and going and investing in these funds because they think those are good investments. They don't do that. That's not like their business at all. What they are doing is they are charging fees. Like if they convince you to go buy this fund, they get to charge a 0.05% fee on the fund, and that's how they make money. Their job is to convince me as the advisor to prescribe this to you, or you as the investor that controls your own money to go buy this. But they're not putting their corporate money where their mouth is, saying we think small caps are going to take off like a rocket ship next year. Therefore, we're just going to go put all of our corporate profits in small caps and go to the moon. That's not their business at all. It's none of these fund firms' business. Anywhere you're getting free research, and frankly, even some of the paid research saying, here's what we think is going to happen, and we're brilliant, and this is smart, they're not, and I can't say in every single case, but in the vast majority of cases, they're not putting their money in that stuff. They're convincing you that they are smart and you should put their money with them so that they can charge the fees on this. State Street doesn't care. None of these people care if you actually buy this fund from them or if you buy any of the 100, 200 other funds that they have. They've got 141 ETFs to choose from. And they charge fees on all of them. You can see the expense ratios right here. They don't care if you actually buy their small cap. They just need to convince you that they're smart and you should buy some of their funds or one of their funds or whatever. So just always bear that in mind. Finally, the big takeaway is it is a total waste of your time and energy to worry about this stuff and try and figure it out and go read the unbelievable amount of macro outlooks that we could sift through. I mean, these are just the big boys. These are PIMCO, Vanguard, State Street, BlackRock. I pulled up Wisdom Tree because that's where I used to work. Every fund family out there, every investment company out there, every investment manager out there got some outlook to sell you to convince you that they are smart. So you put your money with them and then they charge the fees on it. They're not investing their own money in those funds, at least at the corporate level. So it's just a waste of your time and energy. You're setting yourself up for disappointment. Okay. So that's the outlook. What am I doing about it? Let me get rid of all the rest of the mess. Okay, what am I doing about it? Well, I don't try and predict anything. I try and keep fees low. I try and mitigate tax repercussions of your investments. And what we really care about is designing a portfolio for you that balances risk and return such that you don't have to worry about what's happening in the stock market. If you are younger and accumulating money, like you can't even touch your 401k and IRA assets till you're like 60 years old, roughly. And you don't want to touch it until later than that. So for a lot of you, the money that you're putting away, if it's down right now, like you can't even use it anyway for 20 plus years. So it's really not that big of a deal. What we focus on for you is making sure you have adequate cash reserves, adequate liquidity to fund you should disaster strike, getting your disability insurance and life insurance and estate planning stuff in place. That is way more important to you than what is happening with stocks. And frankly, if you've got 20 years to accumulate stocks before you can even use them, you want the prices to be low. If you are a retiree, then we're designing your portfolio to make sure that you've got enough cash and short-term liquid instruments such that you don't need to sell off stocks when they're down like this, and you've got a runway. So it's all about the allocation. So what am I doing? One thing is you may hear about this. People that are investment gurus and have like, here's what we're going to do. It's the trade of the century. You're going to hear this, profit off of bonds, because bonds have had their worst year in history. Let me clean this up. Bonds have had their worst year in like modern history. So a lot of people are going to say, I heard it on Bloomberg Radio this morning, taking my kids to daycare. There's people that say this is the trade of a lifetime. Long-term bonds are down 28%. These things are going to go to the moon next year. There's going to be a recession, and because of recession, interest rates are going to come down. And for every 1% down in interest rates, you can get like a 17% upside return in your bonds. So this is like a no-brainer. This is what we should do. I disagree. I am not looking for capital gains in your bond portfolio. Bonds are not, we want capital appreciation in your stocks. That's what stocks are for. They're the risky asset that we want to take risk with. Bonds are not. Bonds are supposed to be ballast, volatility dampeners that can pay, an income, a yield, whatever. And I think the risk reward trade-off is still pretty bad for this, and I'll show you why. So yeah, if the Fed does, actually, this is the short term. Fed controls short term interest rates. Over here, we're talking about 30-year long bond interest rates. So Fed controls, very short term. We're talking about 30-year bonds. The Fed can affect this, but not as directly. Really, what determines long-term yields are future economic growth and inflation expectations. Those are the primary drivers. So anyway, you could get a 17.5% per 1% decrease in long-term bond rates, but you could also lose 17.5% if long-term rates keep going up. That's like a wild range of returns for what is supposed to be a low-risk asset class. And so that's a huge risk. Like, think about this as like the risk range, plus or minus 17%, let's call it, just for 1% move in rates. Remember, this year rates moved 4%. So that I'm just saying 17 for 1% move. That's a huge disparity. Could work for you in a good way. Could also work against you in a terrible way, like it has this year. And in the meantime, what is the yield that you're collecting while you wait around to find out? Well, on long-term bonds, the yield curve is actually inverted right now. I can show you that in a second if I remember to do it. You're actually getting paid less to hold longer maturity bonds. So you're getting paid less in yield for this risk than you're getting paid in yield for this risk. So if we look just on a risk return perspective, what do we, and we're thinking about bonds where I'm not looking for, shooting the moon, capital gain appreciation. I'd rather capture 4% in yield and have less downside risk. I have less upside risk also. So maybe we missed that. But I don't really care. And here's where I'm going with this. I don't own either of these in my client portfolios, and I don't plan to. What I think is a really great risk reward trade-off is short-term treasuries. Short-term treasuries are also yielding around 4% right now, and yet they have even lower risk, both up and down. And again, if long-term interest rates come down next year, there's a recession and long-term interest rates come down, we will miss a big capital gain in bonds. I'm willing to take that risk. That doesn't bother me at all. This is a very unattractive risk-reward trade-off because, we could get a bunch of gains from interest rates coming down, but we could also lose significantly if rates go up. And I just think that's a really bad risk-return trade-off when we could be in something that has just much lower sensitivity to interest rates and pays you an even higher yield. So this is where my head's at. This is where if clients have bond allocations in the portfolios, this is going to be a part of it. These two are not. This isn't going to be the entire thing, but these two are not part of it. So it's possible that there's a big rally in long-term bonds next year. I'm not playing that game and trying to profit off of bonds. The next thing I would say I'm doing is, so I sent everybody a risk assessment. Thank you to those of you that completed it. Everyone for whom I manage money has completed it. And then some of you were bringing money over and we need to make sure you complete it. But basically we want to target a certain level of movement that is comfortable for you. And because markets have become more volatile overall, we were able to reduce the amount of risky stock holdings and still get the same level of up and down. So let's say we're taking a ship across the ocean for like your investment career. So we're going from the East Coast of America to the West Coast of Europe, and Europe is your retirement. And right now you're in your career working, and we're on this ship going across, and I'm like driving your ship. So I could tell you, look, mathematically, we just buy the fastest speedboat we can possibly find, and we just drive straight across the ocean as fast as we possibly can, and we'll get there as soon as possible. That would be like me assigning the riskiest of risky stocks to you. And academically, that should get you to retirement the fastest. But think about if we're on this ship, like you run into a storm and you're in some tiny jet speedboat, you're going to get destroyed. You'll get capsized. You'll get completely blown up. If you don't do that, you're going to have a bad time anyway. Just when the waves, when the market is super volatile, it's going to make you sick. That's like your risk tolerance. When I'm trying to measure your tolerance for volatility, how much volatility can you take before you get sick from it and demand to stop the boat or get off the boat or whatever, which is the worst thing we can do. That's akin to going to cash and investing. That's your risk tolerance. We also try to measure risk capacity. How much risk can you take? How much loss can you absorb without it meaningfully impacting your financial future? That's like how structurally safe is your boat. So if you're going to inherit $10 million before you retire, you got a lot of capacity for risk because you're going to inherit $10 million and you could lose everything and you'll still get $10 million later. Your boat is extremely structurally sound. If you have $100,000 in income as a retiree and you spend $100,000 every year for basic needs, you have no capacity for loss. So your capacity is very low. So we use these things to try and determine what is the appropriate risk level for your portfolio, custom to you as an individual. And it's not just based on your age, like a target date fund kind of thing. A lot more goes into it than that. And we design the portfolio for you. And let's say that your target risk was 60 out of 100. Well, a year ago, to get to 60, let's call it to get to 60 miles an hour, let's just say, you had to have a certain degree of stocks, of risky stocks to get you there. Well, now, like, the waves are choppier, a lot choppier than they were. So you don't need as many stocks or as much risky stock to get the same speed, to get the same level of volatility that we're targeting. And so the way that manifested itself, not for everybody, but for some people, we were able to reduce emerging market stock. And we were able to increase some of the bond allocations, because where bonds used to pay zero in interest a year and a half ago, now they are paying like in the 4% range. Not all of them. That's not a promise of return or anything, but they're paying more than they used to. So we are able to add that kind of stuff to your portfolio without reducing the overall kind of volatility profile of it. And that's what was happening in the fourth quarter with me, kind of in the background doing this stuff for you. And then focusing on the allocation, I just gave a big speech about that, so we won't go into that. That's really it. I have a little slide available to myself to make drawings, but I'm not coming up with anything to give you right now, so I'll cut it off there. That's my review and outlook. We don't know. We don't care. The experts don't know. Everybody's smart. They all have good ideas. No one knows what's actually going to happen. It is a total waste of your time and energy to try and figure it out. I read all this stuff like constantly. I'm very, very, very aware of what people are saying, and I'm telling you, there's no clear signal. There are things that could happen that would do one thing, and that would be an obvious domino effect. But they could also happen another way and go another way, and that would be So we don't know. All we're doing is just designing a portfolio that's right for you, for your long term, and keeping fees low, minimizing your taxes, and just taking your mind off it, kick back and relax, and don't worry about what's going on in the stock market. All right. Thank you all. Happy holidays. Hope you all have a great time, and talk to you soon. Bye.